Hi, I'm Brett from Metropole. Well, with interest rates rising, is now the time to shift your focus to cash flow. It is understandable as the cost of holding an investment property increases, the more interest rates rise. For the best part of a decade now, it has not been much of a concern for the average investor with interest rates at record lows. But with interest rates now rising and more increases on the way, people are getting nervous and their focus is shifting. Adding fuel to the fire is the fact that inflation is also increasing cost of living pressures for many households. I've heard many investors suggest that their number one focus is finding a property that is either giving them money or looking after itself. In my mind, taking on that strategy in this environment is a flawed approach to investing. They are thinking short term to solve a problem in the here and now, rather than longer term and their specific financial goals. So what is the best approach to take in this changing market? My first piece of advice is to understand what residential property in Australia is. In many different areas and different locations around the world, property will perform and act differently. But in Australia, historically, it's a high growth, relatively low yielding asset. And to try and change that is to try and compromise the environment and what you're trying to achieve. The first thing to understand is that cash flow can be beneficial, but capital growth can be life-changing. And that's not more evident than what's happened in the last 12 months. Properties have performed around 20 to 30% around Australia. On a $500,000 property, that could be another $150,000. On a $1 million property, that could be up to $200,000 or $300,000. It doesn't hold a candle to an extra $5,000 or $10,000 per annum. So it's really important you understand that. If you're going to invest like the average investor and chase cash flow and try and solve your short-term problems, you're going to be severely hampered over the longer term. And that's probably the reason why the average investor never creates enough wealth to be truly independent. The second thing to understand is a property is not cash flow positive or cash flow negative. It's all got to do with the way the property is financed. Negative gearing and positive gearing is an outcome. We can change the outcome, but we can't compromise what we're looking for, and that's a high growth asset. We help many of our clients to close or reduce or eliminate that cash flow gap by lowering their loan to value ratios, by putting down larger deposits, by changing from principal and interest to interest only, and also potentially by doing upgrades, minor upgrades, cosmetic upgrades to close that cash flow gap, increase the rental return as well. But we're not compromising on the growth of the asset. Savvy investors also understand you need to buy time. It's okay for a property to cost you $5,000 or $10,000 per year, especially if you manage to have a buffer in place. If your property's costing you $5,000 per year and you've got a $25,000 buffer, you've just bought 5 years worth of time. And I can guarantee you in 5 years' time, it's going to be very different. So in my mind, it's really, really important you shift your focus from investing in the shorter term and get to the next level. Create a property strategy, create a property business where you can ride these times out, you can buy time in the market, and you're not compromising long-term capital growth by having decades in that particular market. As I said before, cash flow can be beneficial, but capital growth can be life-changing, and it's not the time to compromise your investment strategy. Thanks for watching.